Hello, this is Andrew again, and I wanted to make this video and explain this chart that I've been posting recently in the Quant Stats channel. And let's go back to the chart for a minute. So what I'm looking at is this pattern. We have 1, 2, 3, 4, 5, 6 consecutive up bars on the 4-hour chart. So what I want to know, what I was interested in seeing is if I sold at the close of this bar, okay, and held for 5 bars, what would my maximum adverse excursion and maximum favorable excursion be on average across 10 years worth of data. So going back 10 years, I made a little program that would take a trade at the close of this bar and then exit after 5 bars later, and that would be a duration of 20 hours. And so maximum adverse excursion is basically how far, if you were to short, how far does price go against you? Okay, every single point, okay, is a trade. So for example, if we look at this outlier here, I don't know if you can see my, let's see if I can color it or something. Can I? Yeah, there you go. If we look at that outlier, okay, that is an outlier because it's very, that was a trade where we saw a within a 20-hour period, we saw a 200 plus pip move against us, okay, and this is crazy. And then another almost like maybe 180 pip move in our favor. Now I don't know which one came first. By looking at this, it's impossible to tell, so maybe the 180 pip move came first, then the 200 pip move came second. But that's basically what this means, is that within a 20-hour time, within a 20-hour window, it kind of gives you what the maximum drawdown was and what the maximum number of pips in your favor was. So the nice part about this chart is it kind of gives you an idea of what is normal and what is abnormal, okay? Anything in this red area is normal. It's close to expectancy, right? So on average, you get maybe 50 pips against you and maybe 30 to 50 pips in your favor. And so this is kind of like a topographical map, I believe. That's, I think. Anyways, it's, like you can look at a map and you can see elevation lines, right? So in statistics, you can kind of view this as a top view of a mountain, right? Where the peak of the mountain is where most of your samples fall, and then anything that is kind of less likely to happen happens near the base of the mountain, okay? So I hope this explains this chart a little better. I know it was a little confusing when I posted that up there, but it's just, I like to try and find charts that give me some type of information that may give me a little more objectivity when I trade, right? I want to know what I should expect. I want to know what the worst case can be, and obviously, the worst case could be, you could have outliers that are 400, 500, 600 pips out. We don't know what that is. These are black swan events, right? These are events that are really hard to quantify because they happen, but we don't really know. There's a very small chance of them happening, but they do happen and they will happen. So, but more importantly, this tells you where stuff usually happens. Stuff usually happens in this range. And so it can, it could be a good way to, I have to think about how we could use this, but it could be a good way to maybe set a stop loss or space out, maybe a way to space out your trades accordingly. If you were to take a first trade here, you'd probably be a little hesitant adding too quickly. Maybe you want to add, maybe you want to give it 5 bars before adding, because maybe 5 bars from now you'll be in profit. So I don't know. I think it's an interesting chart. I hope you guys find it useful, and that's it for today. Thanks.